This tutorial covers portfolio analysis during an economic downturn. We call it the ABCs of portfolio risk assessment and credit strategy. The world is upside down. There is a general future business uncertainty during this stage of the global pandemic, and we have a lot of difficulty analyzing our company's risk, particularly as it concerns not only individual customers, but the portfolio in total. So, can we predict portfolio risk? I characterize it this way. Predicting portfolio risk in the middle of a global pandemic like we're engaged in is like trying to explain to your child how big the universe is. We can use common sense, we can use science, but in the end, it's only an educated guess. So the purpose of this tutorial is to help you make that educated guess just a little more precisely. As of the time when this is recorded, the U.S. Bureau of Labor Statistics has told us that the true unemployment rate is close to 20%. This is something we have not seen since the Great Depression. The recovery can only happen once the virus threat diminishes, and we're not quite sure when that will be. And once it does, we're not quite sure how quickly business is going to recover. It could be a V recovery, it could be a slow recovery. Nobody really knows. The learning objectives for this tutorial is, first of all, to give you an overview of credit portfolio management. We're going to try to understand portfolio risk analysis and the components of that, and then certain actions that you can consider to go ahead and review your company's portfolio. And lastly, we'll talk about the portfolio analysis cycle, which kind of ties it all together. So how do we define portfolio analysis? It's the consideration of components of a company's accounts receivable exposures and mix of customers. Very important concept because you're looking at various things that can be predictors of risk. It enables you to make timely collection actions because you better understand what the potential behavior is of your customers and where slow payments might arise and where there could be risks. It can help you anticipate or reduce at least bad debts. It'll help you approve credit lines that really are aligned with your analysis, and it helps you align the appropriate staff resources that you need to maximize profitable collections and revenue and manage your potential losses. So you can direct your staff to where there are opportunities to collect and think of other means where a segment of your portfolio represents significant risk and really shouldn't have a lot of staff time devoted to collecting. So here's an overview. You have to look at the big picture to manage the risk of a portfolio in its entirety because there are a lot of components. It's strategic. You got to think in terms of what your company's goals and objectives are and how to set a strategy for how you're going to manage your portfolio, how you're going to assess credit risk, require collateral, for example, your collection process, and strategy is all wrapped up into portfolio management. And every company has a different risk appetite. It depends a lot on your profitability, your competitiveness, how aggressively you're going to market. So you need to understand what the true risk appetite is for your company. It requires data, and sometimes you have to do fairly complex analysis to really understand how to model your portfolio. It requires an understanding, again, of your company's financial and sales and competitive objectives. So you really have to incorporate how you analyze and manage your portfolio based on what other stakeholders are looking for, particularly your senior management. What is the value of portfolio risk assessment? Why do we even do it, and why do we have a strategy? You have a plan. You've thought it through, and you've documented it. Again, it's consistent with your company's financial and sales goals, etc. It's updated periodically because things do change over time. We're all aware of that. And you need to make adjustments because business circumstances or competitive issues or risks arise in certain segments of your portfolio, and your company's objectives may change over time. So it's not a static thing to analyze your portfolio risk and to set a strategy. It looks at a very diverse set of trends within channels of sale, based on customers' creditworthiness and how that fluctuates, and the location, region, country, wherever you're selling. So you really have to consider a lot of factors. And once you've done that, then you can set a documented plan and strategy.